The next topic is corporate failure. The last class we have finished with how performance is measured in profit organizations and not-for-profit organizations as well. We have considered all that. Of course, we have not taken up any case study on these topics. After we finish the content, I think at a stretch we will be discussing case studies on all these topics one after the other. So the next topic here, what we have is corporate failure. So let's look into what are the reasons why corporates fail. Okay. Uh, did we do this one, Abhishek?
No, ma'am.
Yeah, we did. The reason why corporates fail, because see, when the external environment, there are many changes that are taking place technologically. Um, there's a lot of advancement, but if the organization is not willing to change or doesn't change according to the changes that are taking place, then in that case, that will be the main reason why corporates fail. So, see that complacency, that is a satisfied attitude in business doesn't work. See, when things are changing, they also have to catch up with the changes. They cannot be satisfied with the way they are operating, because that will soon prove out to be as outdated, and they will be out of the market. So that should not be the case. So strategic drift, the slow incremental emergence of strategy when radical change demanded by the environment. When there are um, changes taking place at a dynamic level, dynamic pace, the technology is changing. If they are not willing to change, but they still prefer to change at an incremental pace, slow and incremental pace, that will um, put them out of the market. That is one major reason. If the management is not able to manage the affairs of the business effectively, poor marketing, poor quality, poor acquisitions is also one major reason. See, to acquire another business, because if growth has to happen, either growth happens at an incremental pace or at a dynamic pace, where they either join hands with someone else, joint venture, they get into a joint venture business, or they can also acquire another business. So when they acquire another business, the size of the business increases, the volume of activity increases, profitability increases. That is all with that intention acquisitions take place. But see, when another business is acquired, all the funds are tied up there in the acquisition. Now the acquisition has to see the subsidiary, if it happens to be profitable, or if they are able to manage the subsidiary as they are managing their own parent company, then things would be fine. But if there is any issue there, if there is an impact on the profitability, no cash flows, then as it is, all their funds are tied up in acquisition. And on top of that, if there are no cash flows coming into the business, then that will have an impact on the liquidity, and slowly it will lead to failure of the organization. So acquisitions, as they look attractive, so is the case with the amount of risk that is present in acquisition. So um, acquisitions is another thing. They are unable to, because it may not be the same business, it will not be the same manner in which the activities are carried on in the subsidiary. So subsidiary may be operating at a different level, different environment, different style and functions which are applied there, different from their own parent company. So in that case, if they cannot handle that, they cannot manage the acquisition effectively, that could also be another reason for failure. Failure to adapt to changes in the environment. So they cannot face the strategic, competitive, um, competitor strategies and all. In that case also, that's another reason. If too much of investment is made into one large project, okay, just like acquisition, one large project, funds are all tied up in the large project. Large project only if it happens to be a profitable one, then they can come out of that. Otherwise, if the project fails, then that will have an impact on the entire organization. So that is one reason. Then inability to raise sufficient funds. There are many reasons why they are unable to raise sufficient funds. Sufficient funds, the concept arises because of what is the proportion of their capital as of now? What is the amount of debt versus equity that was raised and invested into the business? So, if we are talking about debt versus equity, if already they have raised a lot of debt and invested in the business, raising additional debt becomes a problem because the debt has these obligations of meeting the cost of capital and repayment promptly on the maturity date. Therefore, the risk is high in case of debt capital. Since the risk is already high in the business, other lenders or other investors would not come forward to extend additional loan. That's one reason. If their liquidity position is bad, if they have a record of not meeting their payments promptly on the due date, that's another reason why investors do not extend additional loans. So any kind of their profitability is not good over a period of time, that could be another reason. So any kind of these reasons, if the investors get to know about, then they do not provide funds. So inability to raise sufficient funds is another reason why organizations fail. Okay, how do we deal with this situation? So why do companies fail? Two main reasons what we can talk about is because they are not able to adjust to the changes that are happening in the external environment, risk averse decision making, complacency, economies of production and administration, limited opportunities for innovation and diversification. So um, there is no scope for them to experiment anything, so it has to go in the same manner, and then gradually they may reach that decline stage and then become fail. So maybe there is a limited mental models. There is only they do not come out with new ways of dealing the business. So because of not changing according to the changes in the environment or adapting themselves to the changed environment, those reasons could be the main reasons for failure. Strategic drift, as the change is happening on par with the change, the entity also has to change. If they prefer to change at a slow incremental pattern wherein the external environment things are changing at a rapid pace, in that case also that mismatch also can result in a failure of the organization. Now there are many methods to assess whether there is a possibility of an organization heading towards insolvency or bankruptcy. But out of those methods, for us in our syllabus, we have two methods. One is a quantitative method. Quantitative method by way of calculating Z score or Z score. So there is a formula given by Altman. We call this as Altman Z score. So by calculating this, we get to understand what is the score. Based on the score, the interpretation also can be given about the whether it is actually heading towards failure or the financial situation in the company is good. So this is by way of Z score quantitative model. There's one more model, qualitative model, which will talk about what are the I mean reasons or factors which can result in a failure. I mean that are happening in the organization that can result in a failure of the organization. That's Argenti model. So first we'll learn about the quantitative model. So when we start working case studies, we will also work out one question on Altman Z score. And there is an exclusive case study in the examination kit. We'll pick it up and then we'll solve this one also. There are 5 variables which Altman has listed out, and these 5 variables are put into a equation. So that equation is represented by Z score. So these 5 variables are x1, x2, x3, x4, x5. So what is x1? Now each of these variables have a coefficient. So coefficients are 1.2 x1, 1.4, 3.3, 0.6, and 1. These are the coefficients of all these variables starting from x1 to x5. Higher the coefficient, greater is the importance, because that variable will be multiplied with its coefficient. So what importance is given to that can be decided by what is the coefficient that is given. So he has identified 5 variables. The first one, x1, is it indicates the liquidity position that is given as working capital by total assets. What amount of investment did they make into working capital, out of the total assets? What portion of them? See, if there are more number of current assets, um, they will be able to promptly meet all their current liabilities. Okay, so for that reason, out of the total assets, what's the portion of working capital? Second, x2. X2 talks about out of the total profits available after distributing dividends to the ordinary equity shareholders, what what amount of profits did they retain? See, if they have retained earnings, it indicates the growth possibility for the organization, because retained earnings are usually retained to be invested into the business. Additional investment, further investment will result in further growth of the organization. Okay. um, it sometimes also is kept in the business to meet any contingent liabilities that arise in the future, but the main reason why retained earnings are retained in the business, earnings that are retained in the business, is for reinvestment will result in growth of the organization, more profits available in future. Okay. Retained earnings by total assets, that's x2. Then we see x3 as x3 has a coefficient of 3.3. So x3 is very important. What is x3? So what amount of profit is available? EBIT, earnings before interest and tax. What amount of profits are available for the amount of investment made into total assets? So generating profit out of the investment that is made. So total assets, as a result of total assets, what is EBIT available? So EBIT by total assets. Then we see market value. X4 is it talks about the market value of both the equity. What is the value of the shares in the market? That is the share price that is present in the market. Based on that, find out the market capitalization or market value of equity shares. Compare that with the total liabilities. How much is the total liabilities amount which is there in the books of accounts, or as such how much do they have to repay? Okay. So that is x4. That's given the least importance, 0.6 only. Then the next one is the coefficient of x5. X5 is about whether they are able to generate turnover ratio. This is basically a turnover ratio. Whether the investment into total assets is able to generate sales. So after sales only we will have the profit available. So finally, what is the profit available is given importance, that is 1.4x2. Then we see the liquidity given the third important position. Then fourth one is whether they are able to generate sales or not out of the total amount of investment made into total assets. And the fifth one is what is the performance of the shares in the stock market. Okay.
Um,
Yeah.
Ma'am, why this 1.2, 1.4, 3.3? Is there
Importance
any?
that is given. See, this is somehow he has arrived at that what weightage should be given, what ranking. I mean, if the ranking has to be given, where would it be? How would it be given importance to? See, profitability. If the profitability is good, the rest of it will all be in its place. So first thing is he's given importance to profitability. So he has come out with a fixed variable called as 3.3. So this is the weightage which he has given to profitability. Then these are, how did he define these things, or how did he come out to this particular thing as 3.3, 1.4? I mean, it is his understanding about that, how he has assigned these weights to these variables. We do not have any, I mean, uh, in details about how did he derive this equation or arrive at these values. This is just that he's given some weights to each variable. So ranking wise is ranked this one as 1. Then the profitability part of it, which is retained in the business, which can help in growth. Then the third one is about the liquidity. Fourth one is about turnover, activity level. And the last one is the performance of the stock market. Now, after the value, the Z value is calculated. If the Z value is above 3, the calculated value of Z is above 3, we can infer that the organization is financially sound. There is no issue with that. There's no problem that it would be going for bankruptcy or filing for insolvency. There is no such issue. But if the calculated value is less than 1.81, then it is a danger situation. They would soon be filing for insolvency. They are bankrupt, heading towards insolvency. If the calculated value is 1.81 or less than 1.8. But if the value is anything between 1.81 and 3, in that case, some restructuring can be done. Something can be done, reorganization or restructuring can be done, and the situation can be revived. So anything between 1.81 and 3 need further investigation. What are the reasons? Why is it not doing well? What what changes can be brought about, or what new policies can be implemented, etc. Some kind of a reorganization can take place, restructure themselves, so that they can become financially sound. So calculated value, calculated value of Z talks about the financial position of the company. That's a quantitative model. We will definitely solve one case study on that, so you will have a better idea about that. If you say we'll do it today, also we can do it today. uh, Qualitative model is, there's no calculation which needs to be taken up, but identify whether there are any defects, mistakes, or symptoms of failure. If there are defects, what could be defects? Defects like, if the management is weak, not able to manage the effects of the business, poor quality, poor management, not taking appropriate decisions at the right time. So management weaknesses, and the accounting policies and procedures that are followed, there may be certain deficiencies. See, the way things are valued, the way certain items that are valued in the organization. So that also has an impact on the profitability. If sufficient profits are not projected or shown, so these stakeholders expectations also will be connected to the profitability position. So if the profitability position is not appropriately reflected in the financial statements, let's say accelerated depreciation method, if it is adopted, so what does it indicate? They are showing a huge amount of depreciations in the initial years. In the early years, they provide high amounts of depreciation in the books of accounts. So that will have an impact on the profitability. Profits shown in the books of accounts will reduce. The intention behind that is to um, reduce the tax burden, reduce the tax liability which they have to pay. But simultaneously, that will also have an impact on various stakeholders. They may not continue to associate with the organization because of their profitability position, which is reflected in the financial statement. So such kind of deficiencies could be there. Accounting for certain unearned revenue in the current year, showing the amount of profit to be very high, but in reality, they do not have such high profits or such high revenue. They are just accounting in the books of accounts. So some kind of um, accounting policies which they have adopted could be uh, that could not be appropriate, so that could result in having an impact on the stakeholders or the future activities which they are taking up. So that is one defect. So if there are defects which are identified in terms of management weaknesses and accounting deficiencies, mistakes are high gearing indicates about the amount of debt that is um, employed in the business. High amount of debt always increases the risk, because irrespective of profitability situation, debt on the debt capital, interest has to be paid. So that will have an impact on the liquidity. Further, no one else will or lenders or investors will not come forward to extend additional funds whenever they require. So high gearing is always very risky. So if at all they have raised too much of debt capital to be invested in the business, that's a mistake. Too much of trust in a big project, large project, too much of importance is given, because if the big projects do well, it is profitable, well and fine, but well and good. But then in that case, if the big projects fail, then it will have an impact on the overall organization. Yeah, that's a mistake. um, See, not putting all the baskets in all the eggs in the same basket. So that's the concept. So instead of depending only on one big project, they should take up multiple small projects. So that's a mistake. What are the symptoms of failure? If there are symptoms that are indicated and they are unable to look into that, bleak financial indicators. See, when there are indicators which are indicating that something is not well with the organization, they fail to see that. If they do not understand that, then that also um, can result in a failure of the organization. If they are into creative accounting, that is window dressing, manipulating accounting for transactions which have not taken place or something like that, or trying to inflate the profit or deflate the profit because of the policies which they are adopting. Okay, so creative accounting is, why is there a need for them to be involved in creative accounting? That is something is not well with the organization. That's why they're thinking about window dressing their financial statements, or non-financial signs such as there are delayed investments, not investing when it is needed to be invested, delayed investments, or unable to make the salary payment promptly. So these are all symptoms of failure. So by looking into these things, it is identified about whether the organization is going to become bankrupt or not. Okay, that's a qualitative method. Otherwise, we have other methods, but syllabus talks about only these two methods. So let's stick to these two methods only and learn them. But then, how can corporate failure be prevented? Strategies to prevent corporate failure. So it says that it depends on spotting warning signs and taking corrective action. Um, what is the reason why they are not doing well? Investigate and identify the causes. So once the causes are known, things can be rectified. Take external advice, seek external advice, accept that there is a problem and move on to a solution. Um, may involve major strategic changes. We have learned a concept called as BPR, where they take radical changes because it is needed at that point of time, because everyone else around them have changed, so it is time for them also to change. So if it is required that they have to change, so they should be taking up major bring about major changes in the organization. Put in controls to prevent further losses. Effective control system, internal control system, if they implement in the organization, That will help them to identify if there are any kind of indicators which suggest that there is a possibility of a failure in the organization. So, put in controls to prevent further loss, have effective management systems in place to begin with. Okay. Um, Strengthen their management system. So, then in that case, corporate failures can be prevented. So, that's the end of that topic. From now onwards, until the last topic, we will be focusing on the quality aspect of the organization. What quality is provided to the customers? What efforts are put in? What measures are taken by the organization, etc. Here, this topic about importance of the product life cycle. It is just to have an awareness about what happens during different phases or stages of the product life cycle. What is the amount of risk that is involved? After that, every topic what we will be learning about will be about quality related topics and models, etc. So that is what we will be looking into from now onwards. First, it is about life cycle, importance of the product life cycle. Technically, it is not a separate topic as such, or we cannot expect a exclusive case study, but subtly it would be included into cases where they may talk about what is the um, I mean the life the stage or phase of the life cycle that the organization is in. So did they enter into the market? Did they venture into the market? Are they the first ones to introduce that product? That would be about introduction phase. So we need to understand at each phase what's the amount of risk that is present. So we may not get a question only focusing on life cycle, but this can be part of any other case study also. So a small concept, just let's understand. CBC, the first stage is introduction phase. Introduction phase, the risk is very high because it is not sure whether the customers would accept the product or not. So the risk is high because the chance that their investment will come back or not, see, that is not known. The chances of they not getting back their investment is very high because it is all dependent on the customer's acceptance. So high risk, high likelihood of failure. Then when they move into the next phase, which is growth phase, by then other players also enter into the market. See, when other players enter into the market, only they are there. See that then all the customers would buy from them. But when there are alternative sellers available in the market, the customers will be divided among them. So each one of them now have to fight for their market share. So it is market share is still not sure about in this space. So at this in this stage also we see that the risk is very high. So high risk even in the growth stage because other players enter into the market. On account of that, market share is not sure. Then only when they have the customers coming back regularly, repetitive sales happen. Until then, we do not know whether the customers are regular customers, whether they would come back or not. Okay. So in the growth phase, also risk is very high. The third phase is maturity. It reaches that maturity level where things are stabilized. It reaches the saturation point, and that by then each player in the market will have their defined market share. Everybody will have their uh, market share. There's I mean, a share or a percentage of the customer base. So things are kind of settled. So the risk comes down. Okay, they need not be worried about what will happen with their investment, etc. So risk comes down. Fourth stage is the time when they have to exit the market or it is in the decline phase. So mostly at this point of time they think about the divestment. They want to come out of that market, and then invest it in some other market, some other product. So if it is in the decline stage, there is no additional investment which has to be made. Okay. So because there is no additional investment, no investment to be made, um, they need not be worried about the risk which is associated with that. So risk is at its lowest level, because and in this stage they usually think about exiting the market, divestment, and then they can take up further course of action. So risk is at its low. Company knows that the product is dying, so sooner or later they will just exit from the market. Quality related costs. So first concept is, there are four. What are the different types of quality related costs the organization incurs? See, in that case, there are four different types of quality related costs that are incurred, but two of them are grouped together and we call it as costs of conformance, and the last two are grouped together and we call it as costs of non-conformance. There are four different types of quality related costs. First one is prevention cost. Even before the production takes place, if the objective is to add value to the customers, how can value be added to the customers? By providing quality products. Of course, price aspect is also one thing which is important, which adds value to the customers. Providing the products at affordable prices is also one important thing. But um, a major part of it, or a major importance that is assigned to is for the quality protection. If the product or service has that defined quality, or that um, quality which they claim to be providing, then only it becomes possible to attract the customers and then make them as repeated customers. So all efforts are put in by the organization to ensure that the quality standards are maintained. So first one, even before the production begins, even before they produce any output, ensuring that ultimately the output that is produced is of good quality. Okay. So for that, there are certain prevention costs that are taken up. So prevention costs, like maybe the designing when it takes place, the process how it is designed, the product how is it designed, to ensure that nothing goes wrong at any level. So as the production is taking place, when it takes place, they do not encounter with any kind of a problem or issue. So designing costs are one example of prevention costs. They design everything properly that nothing goes wrong. Next, we see training is provided to the employees, so they are well equipped to take up the process, so that ultimately the output that is produced is of good quality. Prevention costs. Second, as the production process takes place, as the products are being produced, randomly they are picked out. Some of the units are picked out to check its quality. So randomly, when they are picked out for the quality point of it, when they are put for test, so testing costs or quality inspection costs, these are costs of because it is ongoing process. At that time, randomly verifying whether the products are meeting the required quality standards, so we call them as appraisal costs. The final output is not yet produced, it is still in the process. First, prevention cost, even before the process begins, some amount of costs that are incurred, like providing training to the employees. Then we see research is taken up to come out with the proper design so that nothing goes wrong during the production process. This is even before the final output is produced. Then, when the final output is produced, third type of cost is internal failure. So, from the output that is produced, randomly one or few units are picked out. And if they happen to be defective units, then in that case, these defective units have to be reworked on. So some other additional work has to be taken up, reworking cost. Um, if they cannot be reworked, then what has to be done? They just have to scrap it or discard it or something like. So those are all loss to the business. Those are additional costs that are incurred to rework to make them as saleable units. Okay, that is internal failure cost. Then we see external failure cost. External failure cost is when the output is produced. The internal failure, there is there is one good point about that is these defective units are still not delivered to the customers. They're still there in the factory premises or in the business only. All what they have to incur is some additional rework cost, nothing beyond that. So that is a failure, but internal failure. Cause of non-conformance, the last category we see it is external failure. External failure is it's a defective unit produced in the output, and this unit was already delivered to the customer also. So when the defective units are delivered to the customers, that will have an impact on the reputation. So to keep up with that, usually the seller comes out with promises of warranty, guarantee, or within a stipulated period of time if the customer encounters with any kind of a problem. In that case, there are services that are provided to the customers for repairs, maintenance, sometimes replacement of components. In worst scenario, the entire product itself is replaced. This is all taken up by the business to ensure that their goodwill is not affected. The customers are still satisfied. So some services that are provided to the customers after the sale takes place. So those are external failure costs. Okay. So there are four different types of quality related costs: prevention costs, appraisal cost. Prevention is before the process begins. Appraisal is as the process is taking place, randomly checking the quality of the products. So appraisal cost. Then we see that the output is produced but not yet delivered to the customers. At that stage, if it is identified that the product or the units are defective, then additional costs have to be incurred to make these units as saleable units. So that's an internal failure cost. And then the defective units are already delivered to the customers, but to manage their reputation, to make good the loss, some additional um, promises are made to the customers that they will provide uh, services, after sale services for repairs, maintenance, replacement, etc. So that, see, those are all free of cost. During that stipulated period of time, they do not charge anything from the customers. So these are additional expenses that are incurred. We call them as external failure costs. We have two models. One is Kaizen costing and TQM. They both talk about um, an effort to continuously improve their performance. So Kaizen is a Japanese concept. Kaizen costing is a Japanese concept about how would they maintain their accounts? How do they account for the costs, or what would be um, what would they be doing in terms of the cost that is incurred. So when there is a continuous improvement, when there is an effort to continuously improve, so we see that this is a common feature with Kaizen costing, as well as we see that even TQM also talks about continual improvement. But there are points of differences between these two methods. So the Kaizen focuses on taking the feedback from internal sources, so that they can improve their accounting system better. So every time they take up this work, they want to do it better than the previous one. So constantly, continuously improving their method. So this is a costing system. Kaizen costing is a costing system. So the focus here, the main focus here about Kaizen costing is to cut down on the cost control, cost reduction. That's the primary focus of Kaizen costing. TQM's focus is on producing defect-free units. Kaizen's focus is on cost reduction, cost control. The cost reduction, how is it possible? They find out ways to cut down the cost, or how can wastages be eliminated, some measures that can be taken up so that the cost can be controlled. They also follow the target costing. See, target costing, you have learned in PM, of course. Otherwise, also in a short while, I will be talking about target costing. Let's look at what is target costing, the concept of target costing. We'll go back to Kaizen just because target costing, that concept has come up. So I thought, let me explain that to you once. You should be knowing that because this is a topic which was covered in PM. But let me remind this or refresh your memory about what is this concept all about. So usually the selling price is decided as cost price plus profit. So wherein they incur all the costs that are possible to be incurred, add a profit margin and decide on what is the selling price. But sometimes in certain markets that seems to be a luxury. It is not possible that they can decide the selling price because the competition is very high. It is because it's a perfect market. Many sellers are there. When there are many sellers, it is very difficult to decide their own selling price. In case of a perfect market, when there is perfect competition prevailing in the market, in that case, more or less everybody offers the same price. Okay, even if there is a difference, it would be very minute. In such markets, what they do, they just adopt the price from the market. Normally, if the selling price has to be decided, selling price is decided as the cost price, whatever is expected to be incurred. What would they incur if given a chance? The total cost price plus a profit margin. But if the competition is on a high note, in a perfect competition, perfect market, in that case, the selling price will be taken from the market driven selling price, what we call it as. So whatever is the price that is prevailing in the market, adopt the same price and decide on if this is the price which at which they have to sell their products. So they would already be deciding on their profit margin. See, the objective is to earn profit. So profit, the desired profit, they would already be knowing about that. So deduct the desired profit margin from the selling price. The resultant figure is called as the cost price. So this cost price is the targeted cost price. So now they have to spend only this amount of cost so that they can earn the profit margin. Let's put it with the simple numerical example. Um, if they have a chance to incur the cost, let's assume that per unit, if it is $36 per unit, the desired profit, they want to earn a profit of 4, so the selling price would be decided at 40. This is in a situation where they can decide the selling price. But let's say if they are taking the price from the market, in this, according to this particular situation, if the market price that is prevailing is 38, let's assume that. See, already they have decided on what profit they would want to earn, that is 4. So if 4 is deducted from this, this will stand at 36. 34, sorry. 38 minus 4 is 34. If given a chance, they were spending 36, but now because they want to adopt the market price and to earn the profit, the desired profit, now all what they have to incur is cost per unit of $34 per unit. So now we see that there is a cost gap. Here it is 36, here it is 34. So a decision about how to make it possible to incur only 34. So given a chance, if there was no restriction, they would incur a cost of 36 on that profit margin, and then selling price can be decided. Now that if target costing is adopted, now they end up arriving at the targeted cost price. In this example, we see that the target cost price is 34. Now, otherwise they were incurring 36. So now they have to cut down their cost by $2 per unit. Okay. Um, so that is how they arrive at what is the amount which they have to spend. The difference here in the actual cost price and the targeted cost price, when there is a difference, the difference was for $2. So what ways in which they will be able to cut down their cost so that they can match with the targeted cost. So that is the concept of target costing. The target costing focuses on the cost reduction. But whenever we talk about cost reduction, there should never be a compromise on the quality. Quality that is provided to the customer should be intact. Okay. But without affecting the quality, the cost has to be reduced. This concept, there's a term called as value engineering. Value is provided to the customers, but in this process of providing a value, they cannot compromise on the quality. So keep the quality standards as they are, but the other way of providing value to the customers is by offering them at reasonable prices. That is possible when their costs are under control. So that's the concept of target costing. So Kaizen focuses on target costing. So cost reduction is their main aim. The Kaizen is focusing on providing quality or continuous improvement in their process. So continuous improvement, basically, it is possible for them by taking feedback from the internal sources and improving on how much cost is incurred. So comparison of Kaizen target cost and versus allocate versus actual cost reductions. Investigations when reductions are not attained. So to close the gap, they have to cut down their actual cost so that it can match with their targeted cost. If they are not able to cut down, what are the reasons have to be looked into? So that's the concept of Kaizen costing. TQ, on the other hand, also talks about continuous improvement. Their aim is to ensure that there is no defective unit produced in the output that is produced, the units that are produced. So it is about prevention of errors before they occur. Okay? Preventing from a defective unit being produced, prevention of errors before they occur, continuous improvement. It requires real participation by all in the organization. Then management, for this to happen, management has to be committed. Their commitment is also required, management commitment. Okay. The next concept is about JIT. Just in time. I think you have learned just in time earlier also in PM, but I don't know how much you remember. Let's just quickly go through this concept about just in time system. See, the traditional inventory management system has costs that are incurred, which are, which the new technique JIT states that they are unnecessary additional costs. Those can be avoided if they adopt JIT, just in time inventory system. So the conventional system, let's look at the conventional system. So what's the procedure that takes place in the conventional or traditional inventory management system? The first inventory has to be procured from the suppliers. So procured from the suppliers, what is the process that takes place? So to procure the inventory from the suppliers. Suppliers are first asked to submit their quotations, tenders or quotations. So the suppliers come forward, they submit their quotations. From among the quotations, one or few suppliers are selected. Then an order is placed with the supplier. So we see that there is a supplier who's present. Orders are they are asked to submit their quotations. Then, based on the quotations, or supplier is selected, order is placed with the supplier. There is an order that is placed with the supplier. Supplier will now deliver the goods to the business. So the normal procedure will involve receiving the material at the factory gate. They check for the quality of the product. Then the material is moved. See that is moved into the stores department. So it is a time-consuming process that they have to verify the quality of the product. So maybe it could be a random checking only. They check for the quality. Then the units are moved. The raw material is moved into the stores department. Stores department will keep issuing the material to the production department as and when they require the material. The production takes place, the finished goods are then moved into the either the warehouse or the showrooms or the outlet, wherever they would be selling their units. So it would be moved. They are kept available there in the showrooms or outlets for the customers to come and purchase the finished goods. When the customer comes and purchases, then they will receive um, cash. But otherwise, when they have placed an order with the supplier and the supplier delivers the material, the amount is paid to the supplier. From then, their funds are all blocked. See, the funds are blocked in raw material, semi-finished goods, or work in process, and then in finished goods. Finished goods also have to be sold only on sale of finished goods, and that too when cash is received, then the investment is earned back. That is, they get back their investment amount. During this entire period, when the funds are blocked, on these funds, they will be meeting cost of capital. So that's one major cost which is incurred, that is cost of capital. For the investment that they have raised and on the investment, the cost that they are paying on the investment amount is the cost of capital. See, as if the period extends, we call this as operating cash cycle. Operating cash cycle, cash that is being invested into raw material gets converted into finished goods, work in process of finished goods. And then these finished goods, when they are sold, and usually when they are sold on credit basis, when they are sold, um, this will be converted into accounts receivable, but still cash is not received. At the end of the credit period that they are extending to the customers, at the end of the credit period, customer makes the payment, so they receive cash at that time, and they can repay the loans that they have raised. So this is the operating cycle. If the operating cycle is for a longer period of time, so for that long period, they will be paying cost of capital. Okay. So the conventional inventory management system, we see one cost which is cost of capital on the funds and raised in the investment into inventory. Second type of cost is, see, the material is moved into the stores department, so it's there in the stores department, production department, then it comes into warehouse or outlets or wherever it is. Everywhere these units, whether it is in the raw form, semi-finished form, finished form, they have to be kept safely. So there are certain storage costs are also incurred. So we see there are two types of costs that are incurred. One is cost of capital, second one is storage cost. JIT feels that these are unnecessary costs that are incurred. These things have to be eliminated. So they do not, the system as such does not believe in purchasing anything beforehand. They do not purchase, because once the material is purchased, storage costs have to be incurred. So they do not purchase any material, but wait until a time they receive an order from the customer. So first the order, JIT, how does it work? Let's look into JIT system. First, there is an order received from the customer. One second. Okay, so the business will first receive an order from the customer, but because until now they have not taken up anything, they have not purchased anything, will it be possible for them to deliver the goods? It's not possible. So very quickly, immediately, the business will now take up the production work. So order is received by the business, so now production work has to be taken up. But to produce the products, see, because they have not produced anything beforehand, they do not want to produce beforehand, block the capital, or pay storage costs or cost of capital. Nothing, no activity is taken up. Now that the order is received from the customer places an order with the business. So production work has to be taken up. But for the production work to happen, raw material is needed. So raw material also was not purchased. So then immediately they purchase the raw material from the suppliers. Raw material has to be acquired. But we see that acquiring material from the supplier is also a time consuming business. So now here production department will depend on purchases department. Purchases department will depend on the supplier. But suppliers, selecting the supplier is a time consuming. So what is done under GIT system is they pre-select the suppliers. They decide upon all the terms and conditions about the quality, the price, the quantity, everything beforehand. And these suppliers happen to be reliable, dependable suppliers. So they have the terms and conditions agreed upon beforehand. As and when there is a requirement of material by them, promptly the suppliers supply the material to the business. So very quickly, promptly when they supply, material is received by the business, production work is taken up. So they start producing the output so that the customer's order can be met. But production work is also a complicated work. Different types of work is put in into the production work. There are different categories of workers, skilled, semi-skilled, unskilled, or whatever. So here in this case, the production work or the workplace is considered to be as a work cell, one single work cell, in which all the workers are multi-talented, multi-skilled workers. If they understand every type of work, they know how to operate every type of machine. They can very easily replace any employee and take up the work of the employee. So on account of absenteeism also, there will not be any break in the production work. One thing, if at all, if there is any breakdown on the machine, because they know how to operate all the machines, they can quickly fix it. They decide the work, the setup in the workplace in such a way that when the material has to be moved from one process to another process, one machine to another machine, it would not take a lot of time. Setup is also perfectly arranged in such a way that there is no waste of time when the material is moved from one process to another process. Okay, so very quickly the production work also can be completed and the output is delivered to the customer. On delivering the order to the customer makes the payment promptly. So when the amount is received, they can pay it off to the employees and the supplier, etc. See here in this case, in case of JIT system, they are not incurring any storage cost because they are not purchasing anything beforehand to store them, or they are not even storing the finished goods. As the production is completed, they are delivered to the customers. So there's no amount of storage cost which is incurred in JIT system. That's one thing. The second thing is, see, they are not investing anything into raw material. Everything is taken up immediately. Promptly they receive the amount from the customer, with which they can settle all their costs. So the concept of incurring cost of capital or cost of these funds that are raised also doesn't arise. So these two costs can be completely eliminated. So that is the advantage of GIT system. Theoretically it is very attractive, but it also involves high amount of risk. Anywhere, any breakdown, any kind of a interruption or disruption or any delay, sometimes the supplier may fail to, though they select a reliable supplier, but things may not be perfect all the time. If the supplier fails to deliver the raw material, work cannot be taken up. If there is some problem in the production work cell, if there is some delay, then in that case also they cannot deliver the goods to the finished goods to the customer. Once they lose a customer, that will have an impact on their goodwill and reputation of the business. So that will affect their business. So it's highly risky. But in terms of the benefits of GITs, they can cut down on their cost drastically. No storage cost, no cost of capital. Therefore, JIT is a cost reduction method. Okay. Um, See, the concept of JIT says that to produce or to procure products as they are required by a customer or for use only when it is required. Unlike in the traditional method where they do not know whether the customer would come on a particular date, but based on some anticipation, some estimations of the future demand, they take up the work in the present, complete everything, keep the goods available for the time when the demand would arise. By then, everything is kept available for the customers. So just the customers approach, they pick out the products, and then sale happens. So that is the traditional system. But to reach that, um, see, to meet that anticipated demand in the future, everything is taken up beforehand. Now that is not what is done under GIT. So everything will be taken up just at the right time, just in time. Okay, so there is nothing which is uh, taken up beforehand, but everything at the right time. This would be to eliminate waste, quality, control quality, and reduce stocks held through efficient production planning. For such a system to work, there is extremely important planning, production planning that has to go into the work. Next, we see that um, there should be good relationship with local suppliers who will guarantee the quality of the material they deliver. Quality, quantity, the price, everything would be pre-decided. And they, every time when an order is placed, promptly they deliver quality products. Okay. So that requires good relationship with the suppliers. Now, this will be with a commitment to continuous improvement and a search for excellence. So, there is a constant, continuous effort put in to improve their process, the production, etc. So, continuous improvement and a search for excellence. So, the advantages are very good, but you should also have, let's say, if the case study discusses something about the JIT, you are answering a question on JIT. What are the risks that are associated? You should also be able to express what are the risks that are present in JIT system. Next. The next concept is about Six Sigma. Six Sigma aims at eliminating the defective units. See, initially this was designed um, the concept was designed for manufacturing, but it can also be used in service business. How did this name Six Sigma, or from where is this name derived from? Is um, you must be knowing about the normal distribution curve. The normal distribution curve extends from minus infinity to plus infinity. There are certain attributes of that. See, the normal curve, so it extends from minus infinity to plus infinity. So it's a bell-shaped curve. It is symmetric. That is when it is it the curve is at its peak when it is at its mean. Mean is equal to median is equal to mode, which is equal at this point. Um, the curve is at its peak. Then the curve will take a bend when it is x bar. Here it is x bar. X bar plus one standard deviation. So at that time, the curve takes a change, or there is a change in the bend of the curve. So x bar plus one standard deviation, two standard deviation, three standard deviation. Of course, because it extends till infinity, we do not know, I mean, the total area covered by 100%. But at x bar plus three standard deviation, 99 point 7% of the area is covered at x bar plus 3 sigma. This is all, this is only to tell you how did the name, how did this concept of Six Sigma, or from where did the, uh, where was the name derived, only for that. So 99.7% of the area is covered by x bar plus 3 standard deviation. So to make it as an acceptable region, acceptable units that are um, produced, the the acceptable region is extended till x bar plus 6 sigma. So x bar plus 6 sigma will cover 99.99999 percentage, which means that unacceptable are very very low. So to ensure that the work that is taken up falls into an acceptable region, and that acceptable region is covered by x bar plus 6 sigma. This is of course not very important, not very relevant for your exam preparation, but how did this name come, the concept of 6 sigma? That's the explanation there. So now this is designed to decrease wastage and improve products. The production that is taken up um, ensures that there are very 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 minimum number of defective units, as low as when for every 1 million units of output, the number of defects are 3.4 defects per million units produced. So it's ensuring that no defective unit is produced, and quality work is taken up. Okay, 3.4 defects per million, so that would be 99.999%. So anything which is there in that balance of that area which is unacceptable, there these defects fall. So as low as 3.4 defects per million. The performance measures are based upon what are the requirements of the customers. In case of Six Sigma, there are certain concepts which are key concepts to Six Sigma. It is critical to quality. Quality aspects have to be given importance. They take care of the quality. Then it is about no defects. Failing to deliver what the customer wants is considered to be as a defect. Not meeting the customer's expectations is a defect. See, it's not always the product, it could be service also. See, the expectation of the customer, if it is not met, then that is a defect. So defect is failing to deliver what the customer wants. Then we see process capability. Process capability, what the process can deliver. Consider that so that the work can be taken up. Variation, if at all, if they see that there is some deviation of variation, what the customer sees and feels, note down what is the variation so that improvement can be brought about. Then stable operations, ensuring consistent, predictable processes to improve what the customer sees and feels. And design for Six Sigma, designing to meet customers' needs and process capability. So these are the key concepts. Then in under Six Sigma, there are different processes that are mentioned, but one process is given to us. It's called as DMAIC. This is included in our syllabus, so only we have to learn about this process only. How does Six Sigma take place in an organization? How can Six Sigma be implemented in an organization? So step by step. So the first thing is DMAIC. D is about defining an opportunity. What is an opportunity? See, now here it is about meeting the expectations of the customers, providing what the customer wants from your organization. So the area where they can work to cater to the requirements of the customers is an opportunity which is available to them. So first identify the area where they have to put in their work. Okay. So that will be defined as an opportunity. First, define an opportunity. Defining an opportunity is identifying an area where improvement can be brought about so that they will be able to meet the expectations of the customers. That is opportunity. Define an opportunity. Until that point of time, what is the performance has to be measured. Measure the performance until that point of time when improvements are to be brought up. So measure performance. Third one is analyze the opportunity. Analyze the opportunity is based on the performance until that point of time. What changes can be brought about? What suggestions can be brought about so that improvements can be implemented? So what changes can be brought about? Analyze the opportunity. Based on that, so how can they improve their performance? Suggestions can be made and implemented. So based on that, implement the changes and improve the performance. Improve performance. After improve performance, then we see as the changes that are suggested when they are implemented, on implementation, continuous monitoring would happen. Continuous monitoring, any kind of a deviation, corrective measures will be taken to control those deviations. That's how the performance can be controlled. Control performance. We will do one case study on Six Sigma process also. We have lean and environmental management accounting remaining in the syllabus. Lean production. Lean production is also just like JIT. What does JIT say? JIT says that take up the work only when it is required. Invest amount into any activity only when it is required. Required, that is, they receive an order from the customer. Lean also talks about something on similar lines. The lean production is a philosophy of management based on cutting out waste and unnecessary activities. So the philosophy or the principles of lean management, lean production talk about a lean system aims to get the right thing to the right place at the right time. And the very first time it is without any defect. So at the right time, the very first time, there should not be any repetition. Once the work is taken up, it should be taken up in such a manner that there is no necessity to repeat that work. Okay, the very first time it should be right. It says The lean system aims to get the right thing to the right place at the right time the first time. Now their aim is to ensure that waste include overproduction, inventory, waiting, defective units, motion transportation, and overprocessing. So in every area, wherever there is any wastage incurred, eliminate that. Identify those activities which do not add any value, non-value added activities. Identify them and eliminate them. Then characteristics include smaller batch sizes, okay, employee flexibility, employee empowerment, workers trained on all aspects, close relationship with suppliers and customers. We see these things also taken up under JIT. So they are kind of similar, JIT and lean principles. There's another name also given to them. These are called as pull systems. The regular inventory management system is called as a push system. They take up the activity, push to the next level. That is, material is purchased, pushed to the production gets completed, it is pushed to the output outlets or showrooms. So that is what is seen under the traditional system, which is a push system. These things are, there is no activity as such which is taken up beforehand, but to meet the customer's requirements, the production department pulls the material from the purchase department, but purchase department does not have anything, nothing purchased until then. So now they pull from the supplier. So therefore it's called as pull system. The regular system is push system. Lean is also a pull system because they take up the activity at the right time, not before the time. At the right time, bringing things to the right place at the right time, the very first time. Okay. Um, there are five S. Um, the, the principles of lean system are based on five S. We see that these five S are systemize, structurize, standardize, self-discipline, and sanitize. These are five S. The five S concept is often associated. So if we are addressing a case study on lean system, see, we need to talk about what are the five S or five principles of lean production system. Things should be all systemized, structure. There should be a structure in place because the very first time things have to go right. They cannot repeat it. So they do not intend to repeat it and waste the amount or incur additional cost. That should not have happened. So for that thing, everything should be systemized, structurized, and standardized. How the work would be taken up. Okay. Then there should be some amount of uh, self-discipline also which is required so that things can be taken up at the right time, that is no delay in the work that is taken up. Some self discipline is required, and the last one is the environment also has to be clean, that is sanitized. So that is hygiene conditions also have to be taken up or taken care of, so that is sanitized. Okay, so these are the five principles of lean system. The last topic in our syllabus is environmental management accounting, EMA. So if we do this one, the content is delivered, but now it will start with the case study. So as much time is allotted for that long time, I will be keeping, I will be solving case studies from the examination. The very last topic in the syllabus is environmental management accounting. Those of you who have missed the classes, um, you can follow the recordings which are uploaded on the um, LMS. Of course, some of them are still pending. I will upload them today or tomorrow, and then you can follow all of them. And then in the future classes, we will be answering um, case study questions. See, environmental management accounting. See, some of the organizations, the nature of work, the activities that are taken up by them, there is some impact on the environment. So the environment gets affected because of the activities which are taken up by them. So that's some amount of pollution that is generated, the kind of consumption of resources which are available. So these things have an impact on the environment. So therefore, there is an expectation that they maintain environmental management accounts. So certain records are expected by these organizations to be maintained. So reports are to be prepared and provided as and when they are required. There are certain um, policies and procedures or regulations which are laid out for these organizations. They have to comply with those rules and regulations. So it is an expectation that they maintain their accounts in a certain manner wherein they are able to provide the information related to environment from time to time. Okay. So in this process of preparing the environmental management accounts or the costs related to that, first we need to identify and estimate the costs of environment related activities. There are four different types. We'll come back to this one. There are four different types of environmental costs. So what are the four different types of environmental costs? The first one is conventional cost. Conventional cost is what's the cost of material and energy which they are consuming. That's the major input. So what is that cost? Cost of material and energy which they are consuming. Second one is if there is an impact on the minds of the customers that this organization leaves an impact on the environment. On that note, sometimes it can have a negative impact on the minds of the customers. So customers they stop purchasing the goods from such organizations. So that if at all if any such thing happens, then the sales which are lost are their reputational cost. The reputation gets affected on account of that. Sales are lost. So it's a cost for the business. It's called as reputational cost. The third type of costs are contingent costs. As of now, there are no costs related to those things, but they would arise in future. Like, see, at the end of the life cycle, certain costs have to be incurred. Suppose if it is a natural resource or natural resource which they are using, it's like a oil well or mine from which they are extracting resources. After the resources are extracted, at the end of it, they cannot just discard it like that, but they have to landfill that, take some measures. Some of the in some situations, see at the end of the life of that work activity, they cannot leave the assets like that. Assets have to be dismantled, some decomposing has to be done. See, those things require cost to be incurred. As of now, they are not there because the process is going on. But in future, there are certain costs which may come up. That is at the end of the life of the business, the activity. So at that time, for their organization, at the end of the activity, they will have to incur some additional costs. That's called as contingent costs. Certain contingent costs that are to be incurred in future. Next is because there is an expectation that they have to maintain the environmental management accounts. Maybe it's an regulation which they have to follow. So when environmental reports are prepared, the cost of producing environmental reports is because these reports have to be provided to the government. Sometimes it is to be provided to the environmentalist groups. Okay, so different stakeholders expect that they provide environmental reports. The cost of producing these environmental reports will be categorized as relationship costs. So there are 4 different types of environmental costs. So identify and estimate the costs of environment related activities. Then identify what is the amount of environmental risk. What is the risk that is present because they are there is an impact on the environment which they are leaving. So, what is the risk which is associated with that? Assessing the likelihood and impact of environmental risk which arises. Then, identifying and separately monitoring the usage and cost of resources such as water, electricity, and fuel, and to enable costs to be reduced. Why are we talking about cost to be reduced? See, certain resources are renewable resources, certain resources are non-renewable resources. So when there is, see, what is the amount of these resources which they are using, they have to keep a track of it. There's no issue with renewable resources, but sometimes there are non-renewable resources which they are consuming. So what measures are they taking to not consume all the resources that are available, but they they take up certain sustainability plans, that is leave certain resources to the future generations. That's also important. So sustainability plan, for example, if petrol is consumed, individually each employee to travel to the workplace, if they are using their individual transportation modes, so lot of petrol would be consumed, or the this fuel would be consumed. Instead of that, to save these natural resources, if the organization arranges a common transportation mode for their employees, less amount of these non-renewable resources would be used. Okay, so what is that they are doing in terms of um, ensuring that the resources are consumed efficiently? So they do not waste any of these resources. So identifying and separately monitoring the usage and cost of resources. Okay, that's the next aspect. Including environment related indicators as part of routine performance monitoring and benchmark against environmental best practices. So follow whatever is the best practice, identify the related indicators, monitor their performance, um, and follow the environmental best practices. One more question, and one more topic which would be connected to environmental accounting is identification and allocation of environmental costs. Identification and allocation of environmental costs. See what methods, what costing methods which are appropriate with those organizations maintaining environmental management accounting. See here, there are 3 methods that are suggested: identification and allocation of environmental costs. First one is life cycle costing. The concept of life cycle costing you have already learned. What's the concept of life cycle costing? So the concept says that um, first estimate the entire lifetime of the product or process. During this lifetime, the entire production also has to be estimated. The output that would be produced has to be estimated, and all the costs that would be incurred during the entire lifetime have to be estimated. So the total cost which would be incurred during the entire lifetime is the total cost, because the total output is also identified, it is estimated. Total cost divided by total output will give what is the cost per unit. Then the selling price can be decided based on cost price per unit. What is the purpose of doing so? See, under environmental accounting, different types of cost, we see that there are certain contingent costs also. There are certain costs which will arise later on. By then, there may be no source of revenue that would be generated. At the end of the life of the process, if they have to incur costs, at that time, there would be no revenue generated. At the beginning of the life cycle also, the introduction phase, before the introduction phase, research and development, designing, these costs, at that time there's no revenue generated. So now costs are incurred before the production, during the production, after the production, until the end of the lifetime, different costs are incurred. All these costs have to be taken care of. Okay. So the revenue that is generated should be sufficient enough to cover all these costs. Therefore, follow life cycle costing, estimate the life, the production during the life, the cost that would be incurred during the lifetime, find out what is cost price per each unit, and decide what's the selling price per unit. So that's the concept of life cycle costing. The second method is ABC. ABC, when would ABC be used? Activity based costing is used when the overhead costs have to be allocated. See, the conventional, the traditional costing system, uh, it allocates the overheads based on some predetermined overhead rates. But activity based costing allocates the cost appropriately based on the usage of the activity. So, also in case of environmental management accounts, if the overhead costs have to be allocated, better use ABC system so that overheads can be appropriately allocated. So that's the second system. Third one is about flow cost accounting. So follow flow cost accounting, which will keep a track of what is the flow of material. See, if we look into that, when the inputs are introduced into the process, the output is generated, but most of the time we see that output is not on par with the amount of input that is introduced into the process. Input and output, when output is not on par with the input, is because there is some amount of loss that takes place. That's the normal loss. If the output has to be increased, what has to be done is the normal loss, if it is reduced, or the wastages, if they can be controlled, the output can be increased. So keeping a track of the flow of material will help them to understand how can they how can they improve the output. That would be by controlling the wastages or the normal loss. Or it would also give them an idea about, um, to have a certain amount of output, what amount of input should be introduced into the process. To have an idea about that, flow cost accounting system can also be adopted. See, this is only in terms of material which is introduced into the process and what output is produced. Along with these flow of material, if the value is also accounted, if the value is also recorded, we call that to be as input output analysis. Sometimes they may only give it as flow cost accounting, or they can talk about what is the input output analysis. Take up an input output analysis and account for what is the cost of input and what's the value of output that is generated, what's the amount of normal loss that happened during the period. Okay, so these methods go with environmental management account. Those organizations which are maintaining environmental management accounting management accounts, I think these systems go with that. So sometimes it can be asked as a suggestion as to um, what methods are appropriate with environmental management. If we do a case study, we will also discuss about these things in the case study. Okay, so that is the end of the syllabus. So the content wise is delivered, but it's always better that we keep solving questions based on different topics. So what's the approach can be understood well. So very long back we have done a case study that was based on risk and uncertainty. The last case which we have done was based on risk and uncertainty. Today, though, now it's almost time, so I will not be doing anything now. we can end the class here. So we will be looking into a case study on characteristics of services. There is one question on hotel industry. Hallmark hotels is one question that covers multiple topics, so we can also take up that. Or see, whatever are the remaining, whatever are the topics which are there after risk and uncertainty, wherever it is, we find case exclusive cases, we will solve it in the class. Is that fine?
Yes, ma'am.
Who left the class? JP. So we'll wind up the session now here. It's only 10 minutes, 10, 15 minutes time is there. Now even if I start a case study, it is not. By the time we read only the. So after we have another class MRB, please join in MRB link and we can have the class in the afternoon.
We can follow the previous link, ma'am. Previous MRP link.
Previous. So one last week I gave, no, I shared, use the
Yeah,
same
yeah.
MRB link. No, this is
Yeah.
APM link, no, that's why I mentioned. This is
Yeah,
APM
okay,
link,
ma'am.
use MRB link, that's okay.
Yeah, okay, ma'am.
Okay, then I'll
Okay,
see you in
thank
the
you, ma'am.
afternoon for
Bye.
MRB and case studies next week onwards. Okay,
Yeah,
bye,
okay, ma'am.
bye, ma'am. Bye.
Yeah, bye, ma'am. Thank you, ma'am.